matches up with those terms of the opportunity zone.
So, good afternoon, everyone. My name is Wendell Harris. I'm with the Chicago Community Loan Fund. Going back to the initial point of having a deep discussion about opportunity zones, I think it's still really kind of tough to talk about opportunity zones. But if we more so hone in on specifically what the duration is needed for the credit, if you're looking for long-term credit, so for example, 20 years, fully amortized in paper, we actually could provide that. We received about $28 million from the Treasury 2 years ago, specifically for multifamily, but CCLF is more so a problem solver, so we look at all asset classes, right? So if we can figure out a solution for the property and the people and the 20-year term works, we would be able to issue for that. And on the front end, we can provide the acquisition rehab and just roll it over into 20-year fully amortized paper.
So you can do it.
We can, yes.
No one,
Opportunity zone is a moving target.
Exactly.
It's still releasing information on that.
I don't think anybody's set up with the opportunity to know a specific product like that.
So let's start down there with Brandon.
Yeah.
Why don't you tell us about like what's the guy look like and the property look like or the investor look like that you wake up for breakfast looking for? How big is the deal? Is the property stabilized?
Sure.
Tell me.
So, I'm not really looking for anybody specific unless they're entrepreneurial in a growth mode, looking to take their business to the next level, and obviously we need a partner to do that. In addition, local focus is huge. They understand their markets and want to partner to grow with them. So I think those are the main components and razor focused on where they're going to be. You get guys, like Tony said, coming from the north side to the south side. That raises some red flags for us even as a lender, just because you're out of your strike zone. So really want to work with people that understand the bigger picture as well, and why they're doing this, whether it's to put kids through college or even just to buy a yacht. But when I go into an office and I see a dream board, that's exciting to me because we're really partners in this. That's who we're looking for, and that's our ideal client. Keep going.
Again, Wendell Harris with the Chicago Community Loan Fund. I would have to agree, there's no specific look. I think it's, for us, it's more so, does the investor have the capacity, right, with regard to the credit ask, right? Whether it is in the multifamily space for us, which is 5 or more units, or even in the small 1 to 4 units, where we can provide acquisition capital up to 120% loan to value. Or if you're a larger scale developer that is interested in acquiring vacant land for future development, we can assist with that. We build to suit terms, right? Whether the investor needs a 3-year term for the real estate vacant property to sit so that they can lay out the plans for the development, right? Or if it is a local developer that has been able to access one of the vacant schools in Chicago, and they need capital to repurpose that. About 3-4 weeks ago, Benefit Chicago released an initiative called Repurpose, in which we received a $5 million investment specifically to assist in repurposing vacant schools in Chicago. And during that same week, we also received a $10 million investment from Chase Bank specifically on commercial retail. So we're looking at the communities holistically to figure out a way to assist, not only assist the people, but to help the people stabilize the assets as well.
I guess I'll go. So my name is Mark Buford. I'm Business Development Midwest for Legal One Capital. Legal One Capital is a national lender to investors that basically we provide debt in the form of leverage in the form of debt. got, you know, and our value add is speed to the market, high leverage. So we can do new construction, single family 1 to 4, up to 95% loan to cost for those who qualify. We're a bridge lender, as Tony mentioned earlier. I do have synergies with both Eric and Tony over here. I'm sorry, Anthony over here. We have synergies together in how we can do business together. So on a bridge lender, we're going to do 36 months on multifamily. And we can do non-recourse or recourse. We're looking at the sponsors, the experience levels. If we're talking about syndication, I know a lot of you guys are not looking for recourse. So we have the options on those. Our rates are going to be somewhere between 7 and 12. We're not totally hard. I call it soft money. We're very flexible in trying to get deals done. Later on, we're going to be talking about Noah's deal. New construction will do single family 1 to 4. So anyone doing developments, again, we can go over just did a deal. A condo, 6 units, 2.4 million. The guy got 95% loan to cost. You know, at about 9.7 and 1.5. So we're going to be flexible on our terms. We're looking to work with investors who want to scale, those who are transitioning from single family 1 to 4 and multifamily. Serious about your business, you know what you're doing, you have systems in place, you plan for what you're doing, and you watch the news, but you don't watch the news. So we're well capitalized with $600 million, and we're national.
So, as I stated earlier, I'm Tony Hawthorne with Community Investment Corporation. Community Investment Corporation has been in business for about 50 years now. We're a nonprofit. We're what's known as a loan consortium. And folk might, wonder, well, how is a nonprofit organization a lender? We're a pooled risk lender. So, various financial institutions and insurance companies have bequeathed us, monies to go out and put monies into because they believe in what our mission is. Our mission is the preservation of affordable housing. Our wheelhouse, primarily what we do is to lend money for the preservation of buildings that are 5 units or more. So we do some of the same things that CCLF does. We work very closely with organizations like the CCLF to do the preservation of affordable housing. But we concentrate more so on housing, whereas they kind of branch out a little bit more and do some different things. That preservation of affordable housing piece allows us to concentrate on fair housing rights and tenant and teaching people how to be landlords. Jessica Civils, Jessica Civils is a trainer for CIC, and we have a well-respected property management training class that we put on probably about 15, 16 times a year.
A little bit more than that.
Okay. We train a lot of folk. And as a matter of fact, some other financial institutions actually require their folk to come to our property management training class because they realize the benefits. You can't just put a pool of money out there and expect folks to know how to manage their buildings without giving them some training to know how to do that. So that's how we're that holistic piece. We only lend in the 6-county metropolitan Chicagoland area. We only lend in the 6-county metropolitan Chicagoland area. So folk who are doing things all over, Lima might be the place for them, or IFF or some other institutions. We only lend in the 6-county metropolitan Chicagoland area. Our biggest source of business is the multifamily. We do 10-year term, 25-year amortization with no prepayment penalty. And most of the time, there's a value add component associated with what we do. Tony mentioned earlier about us wanting buildings to be in good shape. We do. We do. We don't want you to get that call in the middle of the night, about something going wrong with your building. So we want to make sure that if we're getting in bed with you for 10 years, we want to make sure the building's going to be in good, decent, good shape for 10 years, and you're not continuing to get those calls. I'll stop there because I could go on for a minute. But I encourage you guys to, and questions will come. But I encourage you guys to, hit me with anything. Okay.
So earlier on, we talked a lot about risk. We talked about, again, rent control. We talked about taxes going up, water bills going up. I mean, the lender is going to be the biggest investment. We're looking at anywhere between 60 and 80% per se. lender, it's really important to understand what the takeout looks like, so that we can tee it up in a way that makes sense, so that we can easily get out of it and then move on to the next and rinse and repeat. So I think you're starting to see, higher expense ratios on the underwriting side, up to 50% on the underwriting for south side. Let's say north side's somewhere around 30%. There is definitely some kind of factoring in terms of the interest rate exposure. So we're stress testing that up front to make sure that, hey, if this is a 12-month deal, you might be underwriting at 6 or 7, just to ensure that you're hitting that 1 through 5. So I think it's just being a little bit more conservative and to ensure that everybody's protected, but at the same time, we're still very aggressive in terms of terms and also the deals that we're doing. So it's just having an open conversation and being a partner with these folks and our clients to ensure that everybody's going into this eyes wide open.
I would agree. I think it's more so making sure the dialogue is open with the borrower as well as being in tune with the streets and understanding what is transpiring in the market to where we may, specifically CCLF may take a little bit of risk, right? Because there's a risk-return trade-off. If we can step in and provide capital for housing and turn around and fund a small mixed-use building or commercial facility within a half-mile radius, right, and then maybe assist someone with trying to stabilize a school, it starts to look a little bit different, right, during the narrative as well as the dialogue as we're underwriting each individual deal because we know what we're putting our funding into.
So we use 6.5% as a constant for the rate, and even though we're offering the rates today right around that 5% mark, 6.5 is a constant because it's a 30-year moving average, I guess, or something like that. And I think we may have even dropped ours to 6.25 recently for multifamily, but I'm still using 6.5. So it just guarantees kind of, or just makes us a little bit more comfortable knowing that the property will be all right at 6.5%, still get that 1.25, which seems pretty common.
The only thing I would add is we also take a management fee, 4% component in there, in addition to reserves for the number of units in the property, and that gives us that cushion that we would need in order to meet the 1.25 debt service coverage industry standard.
So we're looking at the sponsor experience. I mean, we're going to be consistent with kind of the due diligence from the panelists here, but we're looking at the sponsor's experience. We really want to see multifamily experience if you're in the multifamily space. That you manage property. The management aspect is going to be also key. Who is the property manager? What their experience level is. How are they well leveraged in the market? And the 6 to 9 months of debt coverage. And we're going to be at a 2 debt coverage. But we want to see at least from a reserve standpoint, if you have your 20% and your reserves with experience, that'll get you through the door. That's how we're looking at it right now. We understand it's a rising interest rate environment. But we look at it kind of market by market. Chicago is still kind of undervalued in some areas. But that's how we're looking at market by market.
So the fact that we're not a traditional bank, we're a nonprofit, we kind of look at things a little bit differently. Yeah, we take into account all the numerical parameters that all of us lenders look at, but we also look at the intrinsic value that the transaction may add to the community. That we're looking at that deal in. So we may be able to go up to 90% of cost for a situation. We may be able to relax our DCR down to a 1.18. The transaction makes sense, and that's based upon the investor's buyer. Investors' experience in the neighborhood, how they add value to the community, and how they've actually looked at the transaction. Again, the fact that we're a nonprofit, we don't have if you put the numbers in the box and it comes out black, it doesn't necessarily go. But if you put the numbers in the box and it comes out red, it may go. It just really kind of depends on the transaction.
We're gonna wrap this up. We're gonna take a couple questions from the crowd.
individual, you know, who has, you know, grown up, lived in a neighborhood for, you know, ever your family's, you know, been there. Those are things that are qualitative, you know, values. Whereas, and if it's a situation where you may, you know, not have, you know, the balance sheet that a bank or traditional, you know, lending institution may look at, we would look at those in the qualitative, you know, sense. Does that answer your question?
Yeah, I was asking for the benefit of the audience.
Okay. All right.
Tony Pierce has a question.
Tony Pierce,
Boy,
guaranteed rate.
Tony Pierce, all right, the loan officer.
Yes, sir.
I got my real estate license 20 years ago. I did my first real estate deal. Tony Pierce was my loan officer. And Tony Andrews was the attorney on that deal.
A lot of Tonys in this room.
We also, and I worked over at Enterprise Realty. It was Century 21 Enterprise Realty back then. James Bohannon is the managing broker over there. They've been servicing the Southside community for 30 years. Okay. It's a lot of talent in this room. It's a lot of talent in this room. It's a lot of resources in this room that can help you do things that you need to do to be more successful in what you're doing. The thing that concerns me the most is when I see a one-man band trying to do it all and not tap into the resources that are right next door to you. You know? You got the guy you in the meeting with or passing in the hallway, tap. That's how this thing, everybody sandbag.
But Tony, let me just make this comment before you go to your question. I mean, I think, you know, this is really an excellent panel because you got folk here who send business to the people on this panel. If it's a deal that I can't do, I'll send it to a Renovo or a CCLF, and I'll, you know, get on the phone and call Wendell and say, look, you know, Wendell, you know, this deal is coming your way, or Mark, you know, this deal is coming your way, because we realize there's enough, you know, business out here that we all need.
Hold on. He's a residential loan officer. Resident. That's all right? All
So Tony, when you said you were having this summit, I said I got to be in the room because I'm really glad to see the turnout here. Great people here. But the question I had, because I'm a renovation loan officer, doing mostly 1 to 4 units, but I do get commercial referrals, and I send them to Mark sometimes, and I need to meet some of you guys and exchange cards. CIC, I know, is very big with renovation on the commercial buildings. I know you guys touched on it, U.S. Bank. With a show of hands, which one of you guys are loaning money and giving renovation dollars to upgrade and improve those buildings on the commercial space? And what are you looking at in terms of credit score? You know, usually you're thinking 680 or 700, but do you dip down a little bit more if the deal makes sense?